Welcome back. Markets have largely baked in a 25 basis point hike from the U.S. Federal Reserve Board, and that's what it delivered earlier this week. The question now is, where do we go from here? Let's talk to Kristina Hooper. She's Chief Global Market Strategist at Invesco. Kristina, thank you very much for joining us. Let's talk about some inflation-related data released today, those PCE deflator numbers settling in exactly in line with economists' forecasts and perhaps more importantly at their lowest level since March of 2021.
Well, it's good news. Let's face it, what Jay Powell said the other day was that he's going to be, and the Fed is going to be assessing the next 8 weeks of data. And these are some of the most important data points because the Fed is very, very focused on the PCE price index. It is its preferred gauge of inflation, as well as wage costs. And the employment cost index also came out today, which showed that we're seeing some moderation. We're not where we want to be, but we're certainly seeing some moderation in wage growth.
What do you see ahead for the yield curve?
Well, that's a great question. And we could see some shocks and some momentary movements there just because we have global yield news in the form of the Bank of Japan's somewhat surprise decision. But in general, I think what we're likely to see is something of a continuation of what we've seen thus far. We are, in my opinion, at the end of the Fed rate hike cycle. The Fed is not going to tell us this today because it needs to keep a lid on financial conditions easing. It doesn't want the market to get ahead of itself. But I think what we're likely to see is that the Fed does not hike rates any further because it doesn't need to. There are very significant lagged effects of monetary policy, which are going to not just continue to drive inflation down, but will also have a negative impact on economic growth. That's why I don't think this is going to be a soft landing. I think this is going to be a bumpy landing.
Stock markets are ebullient, you might say, at the prospect of the Fed being finished its rate hikes and the prospect of a soft landing, which you seem less certain of. Are stock markets ahead of themselves right now?
Well, I think some stocks are a bit ahead of themselves, and what we're likely to see in the next couple of months is consolidation, digestion, and perhaps a minor pullback. Because I think what has been erroneously priced in is that we are going to see Fed rate cuts soon. I think we're likely to see the Fed maintain rates where they are until 2024. I think the most likely period when we would start to see the Fed truly contemplate a cut is in March of 2024. That's a way off, and so there is the potential in the shorter term for markets to be disappointed. But I would argue that fairly soon we're likely to see markets start to anticipate an economic recovery, so that by the end of this year we could see stocks modestly higher than where they are today.
You said, and we're showing viewers now some highlights from some notes that you shared with us in anticipation of this conversation. You expect to see an increase in global risk appetite. That sounds like higher stock markets.
Yes, but again, we have to go through that period of consolidation, of digestion, and potentially a pullback to get to that point where markets start to discount that economic recovery and truly increase their risk appetite in a sustainable way.
You favor defensive positioning as well.
Right now, yes, I think that makes sense, just because we're not there yet. We're going to likely see some downward pressure on some of our stands to reason. We've had a very aggressive rate hike cycle. There is going to be damage to the economy, but I do believe it's going to be a fairly short-term downturn. I think of this as an anemic slowdown because it's a job-full slowdown. So we will get to the other side, and markets will start to anticipate that in advance.
Okay, let's finish with the U.S. dollar, something that's very closely watched in this country because the direction of the U.S. dollar can affect, of course, our currency as well. We view our currency almost exclusively in its relationship to the U.S. dollar. You see weakening of the U.S. dollar over the next 12 months.
I do. Typically, what drives the U.S. dollar is rates differentials, growth differentials, as well as the desire and demand for the U.S. dollar as a safe asset class. I don't think we're going to see a huge demand for it as a safe haven asset class, particularly once we get through a slowdown or expectations around a slowdown. But I do think what's going to weaken the dollar is that the Fed is going to end its rate hike cycle. Now, Bank of Canada is relatively close as well, so I don't think there's going to be a huge differential, but I think relative to a lot of other currencies, the U.S. dollar will be significantly weaker.